Welcome back to the Deep Dive. If you're just joining us, or maybe you were with us earlier this year when we took apart public banks' Q1 results, well, you know what we do here.
We take these dense financial reports, the ones that can make your eyes glaze over, and we try to turn them into clear, actionable knowledge.
And today, we are back for the sequel. This is the critical follow-up, unpacking PBB's latest Q3 2025 report.
Yeah, the landscape has definitely shifted. We've had interest rate changes, cost pressures.
And we really need to understand how this fortress of stability has navigated it all, and critically, solve that old puzzle.
Why does a bank with such world-class fundamentals get such a lukewarm response from the market?
Well, this review is so important right now. PBB isn't just another bank, it's the bellwether, it's the benchmark for prudence and stability in the whole Malaysian financial sector.
So its performance really tells a broader story.
Exactly. Its trends in loan growth or margin pressure, they don't just tell you about PBB. They give you a real sense of the underlying health of the wider economy. Absolutely. And we have a lot of fascinating ground to cover today, especially on how they handled that OPR shockwave. But before we get into the numbers, we have a very quick request. If you value this kind of deep knowledge, please just take a second right now, click that like button, and if you haven't already, please subscribe to the channel.
It genuinely helps us keep making this analysis possible for you.
Okay, let's get into it. We're starting right with the numbers because that Q3 headline, it throws up a conflict that needs an immediate explanation. So when you first looked at the filing, the headline just jumps out at you. It's a bit of a contradiction.
It is.
For the third quarter, Q3 2025, their net profit actually fell 3.7%. It came in at RM 1,842.6 million, down from over 1.9 billion in Q3 of last year.
A drop in net profit for PBB is always going to raise eyebrows.
Right, and especially when you see that their pre-tax profit for that same quarter, it actually went up a little bit. So what's going on here? Why the discrepancy?
That paradox right there, pre-tax strength but a net profit decline, that is the central puzzle of this entire report. It really forces you to look below that top line.
Yeah.
When a bank sees its operational gains, the pre-tax profit, and they aren't translating into net profit growth, it means something is eating those gains further down the income statement.
Absorbing them somewhere.
Precisely. And in PBB's case for Q3, that drop points directly to a few key pressure points.
Such as?
Well, it's likely a mix of higher operational costs, an increase in their loan impairment allowance, which just means they're setting aside more money for potential bad loans.
Being prudent.
Exactly, always prudent. And probably a lower profit contribution from an associated company. The engine's running fine, but the buffers are just demanding more fuel.
Okay, so let's widen the lens a bit to the bigger picture, the year-to-date for the first 9 months. That flattening effect you mentioned, it's even more obvious there.
It really is.
Pre-tax profit grew a very respectable 3.5%, right? From about RM 6.86 billion to almost RM 7.1 billion. But the net profit growth was marginal. I mean, it was up only 0.01%. It's basically flat.
It's almost zero.
So how are they generating 3.5% more gross income, but the final net profit barely moves? What's eating all that growth?
That near zero increase tells you the whole story. It's neutralization, mainly by taxes and provisions.
So it's the below-the-line stuff.
It is. If you look at that gap between the 3.5% pre-tax growth and the 0.01% net growth, the biggest drag is almost certainly from their tax provisioning. The bank is doing well operationally, but a huge chunk of that extra income is getting absorbed by a higher effective tax rate this period.
And that could be for any number of technical reasons.
Sure, an old tax incentive might have expired, or maybe they had to recognize some deferred tax liabilities. Sometimes just the mix of profit between their domestic and foreign operations can make the group's effective tax rate jump around.
And, as we've said before, they are super conservative.
Extremely. They prioritize prudence, and sometimes that prudence costs you a bit on the bottom line in the short term.
And diving into the earnings per share, it confirms this whole story. Q3 EPS was down a little, 9.54 sen from 9.85 sen last year, which reflects that quarterly profit dip.
But for the full 9 months, it was up slightly.
Right, from 27.55 sen to 27.69 sen. So the narrative here isn't one of like a fundamental problem. It's more about a slowdown caused by them being cautious.
Exactly right. If you remember our other deep dives on them, PBB always manages provisioning conservatively. They are preparing for rain. Even when the sun is shining, that's how they keep their impairment ratios so low. But it does create this lumpiness in the reported profit from quarter to quarter.
Okay, let's talk about the big external shock. the one that hit the whole banking sector in Q3.
The OPR cut.
The 25 basis point cut to the overnight policy rate in July. Analysts were flagging this as a key challenge.
They were.
So for everyone listening, let's just slow down here for a second. How does a single, seemingly small 25 basis point cut affect a bank the size of public banks so quickly?
The effect is immediate.
Yeah.
And it's quantifiable. It's all because of something we call asset-liability mismatch.
Okay, break that down for us.
Sure. The OPR is the reference rate for lending. So when it drops, the interest PBB earns on its loans, especially the floating rate ones, adjusts downwards almost instantly.
But what they pay out on deposits?
That doesn't drop as fast, especially when you're competing with other banks for those stable deposits. So you get this immediate squeeze on their net interest margin, or NM. The gap between what they earn and what they pay just shrinks.
And we saw that in the numbers.
We did. PBB stated it explicitly in their filing. That OPR cut led directly to a marginal RM 6.5 million drop in their net interest and Islamic income for the quarter.
5.5 million might not sound like a lot on a report this size, but it's the proof, right?
It's the confirmation. It validates the exact pressure point the analysts predicted.
I remember CIMB Securities, they were expecting a temporary dip because of this. Does this mean the NIM pressure continues into Q4?
Oh, the pressure is persistent. CIMB's view was that you'd see this decline in Q3 and it would probably continue into Q4. The full impact of repricing their entire loan book, it takes time to filter through.
It's a structural headwind for the whole industry.
Globally, yes. And PCB, for all its strengths, isn't immune.
But, and this is where PBB's sheer execution power comes in.
Yes.
Despite that specific RM 6.5 million OPR hit in Q3,
Right.
the overall 9-month net interest income still grew by almost RM 230 million. That's a 2.8% rise.
Yeah.
So if their margins were shrinking, how on earth did they pull that off?
Volume. Robust volume growth. This is the definition of stability through scale.
So they just lent out more money.
A lot more money. They managed to push out significantly more loans and financing, growing their total earning assets fast enough to completely make up for the pressure on their margins. It's simple math at a massive scale.
You earn a little less on each dollar, but you lend out a lot more dollars.
Exactly, and that strength is directly tied to their dominance in the domestic market, mortgages, SME lending, which we'll get into. They're just laser focused on capturing more market share in those high-quality areas, and it's allowing them to outrun the NIM squeeze.
Okay, so if the core lending business is under this constant pressure from things like the OPR cut, the bank has to find income somewhere else.
Right.
And that brings us to their non-interest income engine, or NII.
Yeah.
We talked a lot about the LPI capital acquisition back in our 2024 analysis. How is that new insurance arm performing now? Is it helping them fight that NIM squeeze?
It absolutely is. The LPI acquisition looks like a real strategic success. It's provided an immediate, quantifiable, and non-volatile boost to that NII line. It's exactly what they needed.
And what are the numbers?
In Q3 2025 alone, that general insurance business contributed RM 88.5 million in income.
Wow, 88.5 million in a single quarter. That's a serious new revenue stream.
It is. And if you look at the bigger 9-month picture, the overall NII was incredibly strong. It rose a massive 19% year-on-year to RM 2.53 billion.
19%. That's huge. And it just perfectly shows how these strategic moves are now critical levers for them.
They're crucial for offsetting the structural challenges in their traditional fund-based income.
But of course, it's never that simple. The group NII looks great because of LPI, but I'm guessing not all the other NII streams were doing so well.
That's a very important distinction to make. You have to look at it granularly. The traditional market-dependent fee-based activities, they face some serious headwinds.
Okay, so which segments were struggling during those first 9 months?
There were two main pressure points, and both were tied to the broader market conditions. First, fund management, which is their subsidiary public mutual.
Which is still a hugely profitable business.
Oh, immensely. It contributed over RM 624 million in pre-tax profit, which is almost 9% of the group's total, but it likely saw pressure on its management fees because of the, challenging equity markets and lower valuations.
Even with their massive 34% retail market share?
Exactly. And second, their investment banking arm. It probably saw profit drops too, just reflecting the general slowdown in capital markets, less corporate activity, and lower stockbroking volumes.
So that shows the two sides of NII, right? You have the steady structural income from things like insurance, and then you have the income from market activity, which is always going to swing up and down with investor confidence.
It's a classic bifurcation. One provides resilience, the other is sensitive to volatility.
Okay, let's get a bit more technical now and dive into Other comprehensive income, or OCI. This part of the balance sheet is famous for its volatility. What was driving those big swings we saw?
Right, OCI is. It's like a daily mark-to-market report on their overseas assets and bond portfolios. You see these wild non-cash swings because it reflects unrealized changes mostly in financial investments and, very importantly for PBB, currency movements.
And the data showed a huge sequential shift.
A massive one. The net OCI loss for Q3 was about RM 65 million. That sounds bad, but it was actually a huge 75.9% improvement from the quarter before, Q2, which had a staggering loss of RM 272 million.
Oh, okay. So what caused a $250 million loss in Q2?
Historically, with PBB, this kind of volatility is almost always linked to currency translation differences for their foreign operations. We're talking about Hong Kong, China, Indochina.
So this isn't new.
Not at all. We saw a big FX loss back in 9M24, and it was directly tied to the same thing. Basically, if the Malaysian ringgit strengthens against, say, the Hong Kong dollar, it leads to a non-cash loss when they translate those assets back into ringgit for the group's report.
And if the ringgit weakens, they get a gain.
Exactly, which happened for them toward the end of FY24. These OCI swings aren't cash flow events, you understand, but they are a constant headache on the balance sheet. It just reflects that regional currency risk that comes with their geographic footprint.
So the big picture for NII is a trade-off. Acquisitions like LPI are providing that crucial, stable defense. But their core fee-based activities and the OCI line will always be sensitive to market downturns and global currency swings. All right, let's move to the core of the bank, the fortress balance sheet. This is really the foundation of PBB's entire reputation, is what gives them that defensive profile. Let's start with loan growth. How did they stack up against the rest of the industry?
The 9M25 numbers just reconfirm their market strength. Group loans, advances, and financing, or GLAF, grew at a very healthy annualized rate of 5.4%, hitting RM 441.2 billion.
A massive asset base. But as you said before, their real story is always in the domestic market. That's their cash cow.
It is the defining factor. Their domestic loans grew at an even stronger annualized pace of 6.1%.
Okay, and the industry average was?
The industry's annualized loan growth was only 4.5%.
So they outcoast the industry by 1.6 percentage points. That is huge.
At their scale, that difference is enormous. It shows aggressive and very successful market share capture, and in the highest quality segments too.
And that growth is coming from their core areas.
Their core franchise, absolutely. Domestic mortgage financing, where they have a 20.1% market share. Hire purchase financing, where they lead the industry with a 32.8% share. And SME financing, with a very robust 18.3% share. They are just better at finding, filtering, and keeping good domestic customers.
Okay, let's talk about the other side of that coin, asset quality. This is what PBB is famous for. What do the metrics tell us?
The metrics are, as always, world-class and consistent. Their gross impaired loan ratio, or GIL, was rock stable at an industry-leading 0.52% as of September.
Let's put that 0.52% figure in context for everyone. How good is that, really?
The industry average GIL ratio is around 1.41%.
So PBB's is nearly 3 times lower.
3 times lower. It's an exceptional number, and it's the direct result of their extremely conservative credit risk management. They are masters at weeding out risky borrowers and making sure they have high-quality collateral, especially with that huge property loan book.
And what about their coverage for those loans?
Their loan loss coverage, the LLC, was extremely prudent at 154.8%. This basically means for every 1 ringgit of potentially bad loans, they've already set aside about 1 ringgit and 55 cents.
It's a massive buffer.
A substantial buffer against any potential defaults. It just solidifies their reputation as a fundamentally defensive institution.
Let's dig into that loan portfolio mix because it explains so much about their low-risk profile. When you look at the sheer weight of their domestic focus, what stands out to you?
It's the sheer size of the property portfolio. That is the backbone of the fortress. Property financing, both residential and commercial, totals a staggering RM 279.6 billion.
Wow.
It's overwhelmingly their dominant segment. And crucially, these are loans secured by physical, high-quality assets, which makes them inherently low risk.
How's that compared to their next biggest segment?
Well, transport vehicle loans or hire purchase, that came in at RM 81.9 billion. So you can see the scale of the property lending. This huge weight on low-risk collateralized property loans is the structural reason their GIL ratio is so resilient.
So PBB is really a giant low-risk mortgage lender that just happens to offer other banking services.
Yeah, it's a very good way to put it.
Okay, so we know loan volumes grew, which helped offset the OPR hit. But how did that translate to profit in the different segments, especially when you factor in those rising costs we talked about.
This contrast is fascinating because it shows you exactly where the operational pressure points are. Retail operations, which is mostly mortgages, saw a modest pre-tax profit increase of 1.3%.
Yeah.
But the higher purchase segment, even though it's a major strength for them with that huge market share, it actually saw its pre-tax profit fall by 5.7%.
Wait, it fell, despite the volume growth.
Yes, a RM 32.6 million decrease. And the report explicitly linked this drop to two things: higher operating expenses and a higher loan impairment allowance.
So even though they made more money from interest on more car loans, the rising costs and the money they had to set aside for potential risk completely wiped out those gains and then some.
It outstripped the revenue growth entirely. It suggests a couple of things. One, the higher purchase market is just intensely competitive, so they have to spend more to get that volume. And two, vehicle financing is just seen as a bit riskier than a mortgage. So when PBB sees any macro uncertainty on the horizon, they prudently increase their provisions in those segments first. It protects their amazing GIL ratio, but it means sacrificing short-term profit in that specific area.
All right, let's move beyond the P&L and look at the long-term structural health of the bank, its capital. This is where PBB really stands out as a benchmark institution.
This is arguably their most enduring competitive advantage. They are not just compliant with the current rules. The report says they are well positioned for the upcoming Basel 3.1 framework.
And what does that actually mean for them?
Well, that new framework rewards banks that have exactly what PBB has: strong balance sheets, high-quality collateral, and very prudent provisioning buffers.
We're talking about their CET1 ratio here, right? Common Equity Tier 1.
Yes, the highest quality capital a bank can hold. It's the core measure of its ability to absorb major losses. PBB's group CET1 was 14.256% at the end of last year and was still very strong at 13.816% in September.
And their total capital ratio?
16.543%. These numbers are way, way above the regulatory minimums. It just demonstrates enormous structural resilience.
So what does all that excess capital actually mean for their future and for shareholders?
It means they have massive strategic optionality. They can fund growth without needing to ask shareholders for more money, and they can absorb huge economic shocks.
And analysts have put a number on this, right?
They have. CIMB estimated that every 50 basis points, or 0.5% uplift in that CET1 ratio, could translate into nearly RM 1.4 billion in excess capital.
1.4 billion. That's a huge number. That's enough to completely change their dividend policy.
It is. It's equivalent to a potential 7.2 cent per share dividend increase. This is why you see analysts forecasting potential special dividends for FY26. PBB has a choice: deploy that capital for growth or give it back to shareholders. It's strategic dry powder.
Okay, let's talk about costs. We saw costs creep up in the higher purchase segment. But overall, PBB is known for being an efficient machine. How do they stack up?
Their cost management is still a pillar of their moat. They maintain a very efficient cost-to-income ratio, or CIR, of 34.9%.
And how does that compare to the industry?
It's significantly below the industry average, which is usually around 44.8%.
So a 10 percentage point difference. Can you translate that into a competitive advantage for our listeners?
Absolutely. A 34.9% CIR means for every dollar PBB earns, only about 35 cents goes to paying for operations, salaries, IT, rent, all that. Their average competitor pays nearly 45 cents.
That 10-cent difference is pure profit advantage.
It's a structural advantage. It means they can offer slightly better rates to the best borrowers, they can afford better tech upgrades, or, most importantly, they can drop significantly more profit straight to the bottom line than their peers.
But costs did rise overall.
They did. Other operating expenses were up about 5.7% for the 9 months. Historically, personnel costs are a big driver, but as we saw, even PBB is fighting inflation and the need to invest.
And finally, a quick look at their regional operations.
Right. Their overseas ops showed modest profit growth of 6.9%, which suggests their expansion into Indochina is starting to contribute.
But calling back to our earlier deep dive, the big risk indicator here wasn't about performance, but a major write-down they took last year.
Correct. The big event was in FY24, the one-off recognition of an impairment on goodwill of RM 473.8 million.
And this was linked to Hong Kong.
Primarily their Hong Kong operations. Goodwill is the premium you pay for an asset, and this impairment was basically them admitting that the tough market conditions in Hong Kong meant those assets weren't worth what they once were. It was a big non-cash accounting hit, but it's a constant reminder that while the domestic fortress is safe, the regional expansion carries inherent volatility risks.
Okay, we've broken down the numbers, we've analyzed the strategy, we've quantified the risks. Now let's put it all together and assign a score to PBB's structural competitive advantage, its financial moat.
And based on everything we've discussed, we are assigning a score of 9 out of 10.
A very strong 9 out of 10.
It's robustly earned.
Yeah.
PBB just has these structural advantages that are almost impossible for a competitor to replicate.
So let's justify that score. What are the pillars?
I'd say there are 3. First, scale and cost advantage. That 34.9% CIR versus the industry's 44.8%. That is a fortress of profitability built on their unmatched scale in the domestic market. Second, asset quality and risk management. This is the foundation of their customer trust. A GIL ratio of 0.52%, nearly 3 times better than the industry, fosters deep, entrenched loyalty. It ensures reliable, low-cost funding. Customer deposits grew at 4% to over RM 446 billion. People trust them with their money.
And third, the capital.
The capital buffers, their robust ratios and readiness for Basel 3.1 give them that strategic optionality and shock absorption capacity that we talked about. It's their strategic dry powder.
So the big question, why not a perfect 10 out of 10? What holds them back?
It's the structural drag of relying on a mature, saturated domestic market. They have perfected traditional banking, but they lack a truly disruptive, high-growth catalyst.
So every bit of growth is a street fight.
It is. It requires fierce competition. This reliance on just grinding out more volume rather than some kind of revolutionary margin expansion, it just puts a natural ceiling on their explosive growth potential. Perfected traditional banking isn't a 10 out of 10 growth sector.
And this brings us right to the paradox we wanted to solve. If the fundamentals are a 9 out of 10 moat, if this Q3 report confirmed their resilience, why the lukewarm response? Why does the stock price so often feel stagnant?
This is a classic case of the victim of its own success syndrome. The market has already fully priced in PBB's consistency and its prudence.
So there are no surprises.
There's a limited surprise factor. What did this report really deliver? Profit slightly down, loans great, asset quality excellent. It just confirmed the existing story. Results that are as expected don't trigger a stock re-rating. Investors looking for a 20% growth story are just looking elsewhere.
And there's the market saturation issue. They're already dominant. They can't just double their 20% mortgage market share.
Exactly. Growth from here is incremental and expensive, like we saw with the rising costs in the higher purchase segment. There's no low-hanging fruit left.
And finally, the report just confirmed the headwinds everyone already knew about.
Right. Persistent headwinds confirmed. It reinforced the market's concerns about NIM pressure after the OPR cut. And while PBB managed it brilliantly, the fact that the pressure exists is already baked into the valuation.
So the lesson for you as a listener is to think of PBB as a premium durable SUV. It's engineered for unmatched resilience and safety. It will handle any rough economic road better than anyone else. You buy it for longevity.
But it's not a high-speed Formula One car built for sudden bursts of speed. The market needs that sudden burst for a major re-rating. You invest in PBB for steady, safe compounding, but you have to temper your expectations for the market to get wildly excited about results that are, frankly, perfectly good and utterly predictable.
Their strength is their strength.
Yeah.
But it's also the reason for their valuation ceiling.
So, to sum up the whole Q3 2025 narrative, Public Bank successfully navigated that immediate OPR pressure. They did it by aggressively pursuing loan volume and leveraging the strategic NI contributions from the LPI acquisition.
Yeah.
This quarter really cemented its status as a resilient financial fortress. They defended their margins even when challenged by rising costs and, those necessary provisions in areas like higher purchase.
That resilience, backed by that phenomenal CET1 ratio, it's truly something else. And that leads us to a final provocative thought for you to consider. Given PBB's massive capital reserves and its historically low risk appetite, will the pressure from investors for higher returns eventually force them to use that excess Basel 3.1 capital, that potential RM 1.4 billion per 50 basis points of CET1, for massive special dividends? Or will they instead choose to pursue riskier, higher growth acquisitions overseas and fundamentally change their safe SUV profile in the pursuit of higher speed? Thank you sincerely for joining us on this deep dive into Public Bank's Q3 2025 results. We really hope this analysis has empowered you to look beyond the headlines and understand the powerful story told by the numbers. And please don't forget to like this video, comment below with your thoughts on PBB's future dividends or expansion. And of course, subscribe to the channel for more in-depth financial analysis. Until next time, stay well informed.